Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Welcome to Game Plan for Retirement with Chris Mcintire. McIntyre Retirement Services, Northwest Ohio's retirement planning resource.
And welcome into the program. This is your Game Plan for Retirement with Northwestern Ohio's resource for a common sense approach to planning for your financial investment and retirement futures. He is Chris Mcintire, president and founder of McIntyre Retirement Services. And Chris, happy 4th of July Independence Day weekend to you.
Yeah, and happy 4th of July to all the listeners out there as well. It's like our new billboard says, it's American Pride Month and let freedom ring.
Absolutely, Chris. Yeah, you always have been a patriot and talked about what America means to you and your sense of pride in freedom and independence. And from a financial standpoint, I think that's what you try to help your clients establish in their lives, a sense of financial freedom and independence. And I guess when it comes down to the very root of it, that's what we all want with our money.
We sure do, Peter. And, having some sort of an accountability process, if you will. So sometimes we help people be accountable to themselves, instill some confidence in them in that their retirement plan, they've done a great job and they need a little assistance in taking it here across the finish line, if you will. And, and helping them solve some problems or plug some of the holes where, they have some potential risk or where dollars could be falling through the cracks, if you will.
Well, confidence, I think, Chris, is quality of life in retirement. And we've got to have the plan in order to get that sense of confidence and therefore that quality of life. But studies are showing that Americans are less and less confident about the financial future. We've got all kinds of worries and concerns that I'm sure you're hearing about there at McIntyre Retirement Services.
Probably one of the biggest ones right now, obviously, has been the inflation talk right now. And, the inflation, look at the price of gasoline, the supply chain. We certainly have a number of issues that are driving prices up. It's hard to find workers, so wages need to go up. And that's going to lead to some volatility in the marketplace here, obviously, with investors wanting to be a little cautious, and especially bond investors. If interest rates go up, that pushes the prices of bonds that are already in existence, to lower values. And it can make your statement look, even for a conservative investor, you can have some pretty sharp moves here on the bond or what is traditionally the fixed income portfolio. And I think most of our listeners out there today, Peter, have no idea how the bond market works. They think that is their safe money inside their traditional, stock, bond, mutual fund type portfolio. And we're going to have issues here going forward with the bond market.
Now, traditionally, Chris, that has been the more conservative side of our portfolio, the side that when there's volatility in the market has been that dry dock that people have gone to in order not to take big losses. But we're just not seeing that in today's economy. The balance that was once there with the 50-50 or the 60-40 portfolio with equities and fixed income, stocks and bonds just is not providing the same balance in the volatile times as it once did. And these are kind of issues that we all need to think about and maybe reconsider. And I guess the question, Chris, if the status quo, if what we have been taught to do worked so effectively, would we see this lack of confidence in our financial situation and in our financial future? And that's where I think you take the time to encourage people to rethink what they think they know and challenge some of the myths and the misconceptions and the conventional wisdom and question why things are not as optimistic as the planning that we have done and the hard work and the savings that we have done would indicate it should be. And ladies and gentlemen, if you've got concerns about your financial future, make sure you pick up the phone and give Chris Mcintire a call, because he can walk you through the planning process, make sure that you have a plan in place, or even if you already have a plan, can double check it, spot check it, make sure that it is a complete plan and that the assumptions that the plan may be based on do provide you with a sense of financial confidence, like you have thought these things through and what may happen into the future. You are prepared for them. 800-868-1194 is the number to call. 800-868-1194. And Chris, in order to help your clients and savers and investors throughout Northwestern Ohio have a increased sense of financial freedom and independence, you offer to help them put that plan together with no cost and no obligation.
Yeah, we will sit down with folks and take a look at anything from the Social Security side to the pensions. Obviously, look at the investment mix, do a risk overview for folks, a risk profile questionnaire, see where they're at with everything, and then just highlight for them. Look, here's where there are some holes that you need to fill. This is what everything is telling us, that you've got gaps or potential issues that could disrupt your overall retirement plan. And hey, it might not be about money. It might be about, if somebody goes into a nursing home, if you've got cognitive issues that flow through your family history, hey, you need to deal with that. Those are things that could put you into a long-term care facility for a long time. You might have all of your money in an IRA account where everything you do is going to create additional taxation. So, a lot of people, may have saved enough money, but they haven't done all of some of the other planning there. So that, that's why we call it Mcintire Retirement Services. It's more than just, picking a hot stock or a hot mutual fund. It's encompassing everything that is retirement, long-term care, income planning, dealing with the inflation side of things. How do we, counter this very low interest rate environment we are in right now, with CDs and banks paying next to nothing. And Robin and I just had a CD renew that we had to have, it was only $500, but it renewed for another year. And we had to have like 4 different accounts at one bank to get a lower interest rate when we had a mortgage on the house. And it made 2 cents in the last 12 months of interest on $500. So,
I mean, it's not a
just,
lot of money, but that's a terrible rate of interest. It used to be that we could protect principal and live off of the interest, and we were seeing double-digit rates of return in the interest rates. That $500, Chris, maybe 25 years ago, could have netted you like $50 in interest in the course of 1 year. Now it's 2 cents. That's a remarkable difference. Chris, when you listed many of those risks that we face, and those risks, I think, are the things that erode our sense of financial security. So you gave a great laundry list of them. That can we talk about them maybe one by one, and how we can attack that? For instance, the low interest rates that we're seeing right now at the bank. Is there an approach that we can take without swinging all the way to the other end of the spectrum and taking unnecessary risk? Is there something that we can do that addresses these low interest rates that we're seeing?
Yeah, Peter, the traditional, 60-40 portfolio, so 60% stocks, 40% bonds, or 40% stocks, 60% bonds, really needs some revisiting. And we've been doing that throughout the course of 2021 for all of our clients, and looking at those that are very heavily invested in bonds. The more conservative minded investors is looking at, how do we diversify the traditional bond portfolio, in looking at, maybe some real estate holdings. Okay. Also looking on the traditional inside the annuity space there, where we can get, a higher rate of income off of a lower amount of money than what is typically needed for our bond position. Because if you think about it, inflation is a big threat. I had a CD that made 2 cents, well, the price of gas went up 60% basically in the last year, if you will, and all of a sudden my $500 is worth 350. So we have to help our clients with that as well, and understand that, look, we haven't dealt with inflation for a long time. We have to deal with it now, in looking at non-traditional ways of doing things and changing that paradigm. You and I, we've been on that Roth IRA topic forever, and trying to change people's mindsets on, what worked in the past doesn't necessarily mean that's the best option in the future. And, diversifying the bond holdings is very important right now, Peter.
Sure, sure. Well, Chris, with your 2 cents worth of interest on your $500 CD, and then you mentioned inflation on the other hand, um, is inflation a factor that concerns you for the long-term future? And if so, like how are you structuring portfolios and assets for clients to address this concern of inflation? Is there anything that we can do?
Well, certainly. And, right now we're using some quality annuity products that give us the potential to have increasing income for as long as the annuity owner and the spouse, if it's a married couple, are alive and keeping pace with inflation.
I like the
You
sound of increasing income. Pay raises throughout retirement?
who wouldn't want that? And,
Right.
we deal with a lot of folks that say, well, I've heard bad things about annuities, and, look, there's many different shapes and sizes out there. So, Peter and I would agree on, we typically always use the safe money side of the annuity space. We are not the big into the variable annuity space because of the inherent risk, and the expenses in those can be awful high. So when we use the annuity space for an income play, it's going to be as a safe money position to, help us, as an alternative to certain bond positions, or as a way to complement a bond strategy also.
Well, if safe money strategies, if no risk of market losses, if protecting your income and having the potential for increasing income and pay raises throughout retirement sound like something that would provide you with a sense of confidence in your financial freedom and independence into the future, pick up the phone and find out a little bit more. Chris Mcintire, certainly happy to hear from you, answer any questions, help you with that planning review, that strategy session, get the game plan for retirement together, help you understand the risks that you're taking, the fees that you're paying, the taxes that you may be liable for. All you need to do is take that first step and pick up the phone, 800-868-1194. That's 800-868-1194, 800-868-1194. On the other side of the safe money strategies, Chris, I know that you are a fan of growth in the market and a proponent for that as a part of the portfolio. You help manage clients' assets and investments, also managing the risk in the market. But right now, the past decade has been a fantastic period to be invested. Are we expecting the next decade to look the same as the last? And how are we gauging how much risk we are actually taking with our investments right now?
Sure, Peter. And, always predicting the future, I think it would be safe to say that, don't bet on this incredible amount of government stimulus to help drive the marketplace. At some point, we're going to have to pay down the debt. So obviously, a changing tax environment could be the big threat here going forward for many investors. Is, all of you with, six, $700,000 in IRA dollars or even more, if you have to pay more in taxes to take that money out of there, that means you have to withdraw more to net. So it's almost the same thing. Rising taxes is the same thing as rising inflation. So we may have rising inflation, rising taxation, kind of a double whammy that, a lot of the folks right now are going to have to face within the next 10 years. So planning your taxation is also the same thing as, or just as important as combating inflation, right? Inflation, taxation are obviously going to be very, very important going forward.
Chris, does the changing potential for changing tax environment have an impact and effect on pricing and stability in the market? I understand what you're saying, that if taxes go up, we have to pull more out in order to have the same spending cash, and then inflation becomes a factor in there as well. But does a changing tax environment or changes to tax law, do you see that as having the potential to swing the market one direction or another?
It certainly can, especially if they change the capital gains tax rate. So you bought IBM stock or Amazon stock 5 years ago. You don't own it inside an IRA account. You have it outside of your IRA account. And if capital gains taxes go up, you will see a lot of people cash in some of those gains to pay a lower rate now. So there'd be more sell orders, and that could add volatility to the market. The market is supply and demand, right? So, you'll see some of that. There could be less money that gets inherited if they change some of those tax laws where you get the step up in the cost basis, if you will. So mom and dad or grandma and grandpa bought Amazon stock 10 years ago, and today it's worth $1 gazillion, and you get the step up in basis, which means they die, you can sell the stock, not pay any capital gains tax. The current administration is talking about doing away with that. And we've got that is a key component in what could add volatility to an already volatile stock market, with some supply chain issues and whatnot too, Peter.
It sounds like a pretty significant reason and motivation to be proactive in our planning as well, Chris.
No question about it. And understand, why do I own what I own? If you own it inside your IRA is one thing, and here's the other part of this piece, Peter, is, a changing tax environment can have people hit the sell button a little bit earlier, but also a changing interest rate environment. So if in 2023 they start raising interest rates, which is what we've been reading, looks like it's going to happen. When interest rates go up to a certain level, people are going to say, look, I can move into less risky investments than stocks for capital appreciation and gain. So you may see a shift in assets moving from stocks back into the traditional banking instruments at some point in the future. So that would be a behavior we have not had to deal with in quite some time.
Chris, any reason for the long delay in making that announcement versus when they actually intend to do that? At this point in time, in the middle of 2021, talking about potentially raising interest rates a couple of times in 2023 sort of seems to be lip service, if nothing else, saying, oh yeah, we acknowledge we sort of need to do that, but we're not ready to do it quite yet. Any reason in your mind for that delay and the announcement so far forward?
Sure. They want to give investors a chance to digest that information and make adjustments over the course of time, instead of, kind of getting blindsided with it, if you will. And
The
then
market
all
does
of a
not
sudden,
like sudden moves.
Yep, and it does not like a lot of changes, or the unknown, if you will. And we certainly, with the new administration in place, has a very different tax strategy, spending strategy than the previous administration, to be politically neutral here. But so investors have to get used to the new administration, and then probably into 2022 we're going to have that midterm election, and that is typically when the other party does much better, right? Because in the Trump administration, in the midterm elections, the Democrats came in and got control of the House of Representatives. So, as narrow as all of these balances of power are, that's going to be some volatility, or I should say some unknown. It might not necessarily be volatile if the House was to flip into 2022.
Well, we are talking today with Chris Mcintire, president and founder of Mcintire Retirement Services, your financial investment retirement questions. He's got answers for you. He can help you structure that plan, put that together. If you've got concerns about establishing your financial freedom and independence into and throughout the future, into retirement and beyond, pick up the phone, give him a call. He does offer to assist in answering those questions and addressing the areas of concern, the things that could derail your financial stability, confidence, and quality of life, and to put that plan together, that game plan for retirement, the income, the investments, the taxes, healthcare, legacy, all things that are addressed in that plan. And he makes that offer for listeners to this program. The true value is that you can get that plan together, no cost, no obligation. Just call 800-868-1194. That's 800-868-1194, 800-868-1194. Chris, the things that we've mentioned so far for the concerns we have as Americans for our financial freedom and stability into the future, all of those things for any of us as individuals are sort of outside of our control. But there are some other things that you help people identify that are within our control that can make a very large impact in their sense of confidence and quality of life in the future. One of them being that spending plan, and making sure that we're not overspending, but also giving us the ability and kind of the freedom and permission to enjoy life as we go once we have that plan in place.
Yeah, Peter, sometimes the hardest thing for an advisor to tell a client is you have to slow down on your spending. You're going too fast and spending too much. And, we have had those uncomfortable conversations, but that's what we have to do to serve their best interest. And then it's nice on the other side to tell a client that, look, it's okay to go out and buy the new car that you've been looking for. So understanding, how the spending is working compared to the investment strategy with the income strategy in play there is something that's actually very rewarding in what we do, because it shows that the plan is working.
Well, again, to have that spending plan is about confidence in your spending. It's about quality of life and the ability to enjoy it. We want to live a fulfilled retirement and even before retirement, making sure that we're doing the things that we need to do in order to reach retirement goals, but also enjoying life as we go. And when we have the plan, we can have confidence that we are achieving that balance. And that's what it's really all about. That is the basis of a plan and of financial security. And if you would like to talk with Chris about that, or once that spending plan is in place, all of the additional elements of growth of your investments, of management of taxes, of management of risk, that is what the game plan for retirement is all about. Pick up the phone and give a call, 800-868-1194. That's 800-868-1194. And Chris, it strikes me that over the course of our lifetime, we sort of have an evolution of what provides us with a sense of financial security. When we first go out and start getting a job, it is that paycheck. That's what gives us the sense of financial confidence, the fact that we're showing up to work and we're going to earn the next paycheck. Once we get going, we've got a little savings, we've got an emergency account, and that gives us an additional level of financial confidence. And then we start building the retirement assets. On the day that we retire, maybe in the window, it's probably the lump sum that we've been able to accumulate and grow that gives us enough confidence to transition into retirement. But the day after retirement, it kind of swings back, and it's really all about the income at that point in time.
It is all about the income, and trying to convey that message to folks that say, hey, I've got $1 million in my 401k. It's like, yep, that's a lot of money, but how much do you need to draw off of it? If you need to take $70,000 a year out of it, that's an uncomfortable number to draw out of $1 million a year. That's a 7% withdrawal rate. If you get somebody that only needs to draw 30,000 out of $1 million, okay, that's a 3% withdrawal rate. That's a much easier obtainable goal. So, understanding, what the income that needs to be drawn off of the big number certainly helps us to create a more solid financial plan and income plan, because it's nice when we can create an income plan and then an investment plan. So we have a couple of different buckets here that we're utilizing for folks. And if they've got a nice emergency fund, that certainly helps everything. And, I think nowadays, a lot of the people that are listening out here today have more money in savings from the government stimulus checks and, not being able to travel. So obviously there's a lot more money sitting in savings accounts now than probably has been in the last decade, let's be honest. And, the market has been very rewarding to most folks. Believe it or not, this crazy pandemic really had one bad month in the market. But again, healthy markets are going to have some volatility here. And, you want to see some corrections, because that allows the market to run up again. And so expecting some volatility, we get some shocks to the system, obviously. Inflation could certainly be a big threat here. As things get more expensive, people will slow down on the spending, and that could obviously lead into some sort of recessionary environment also. Right now, a lot of restaurants and some of the travel industry, even American Airlines, announced they had to cut flights because they didn't have enough staff. So if you want to think about that in an economic cycle, that slows things down. Obviously, those are
Certainly.
people that aren't on airplanes, that aren't spending money at restaurants, hotels, rental cars. It has a cascading effect. The Florida real estate market is red hot, almost too hot. The demand is outpacing the supply. It's going to run prices up so high, and eventually that'll cycle the other direction. So you have to understand this economic cycle that we get into, that it's not always going to be in your favor. And for those that are retiring right now after this historic run up in the stock market, what happens if we get into an inflationary cycle and the market tapers off here and we don't get these 15-20% years in the stock market? What if we get 3 and 4%, right?
Or over the last decade, Chris, it's been fantastic. And if we've got short-term memory, that may be all we remember. But for those of us who have been around a little bit longer, we remember the decade between 1999 and 2009, the lost decade there, or 2000 really through 2013, basically was about 12 and a half, 13 years where the market was flat. It was break even. But in the midst of it, it had two different 50% downturns. And Chris, if we look back even further over the last 100 years, we hear that the market always goes up, but there have been 14 periods of time where we had pretty dramatic downturns, on average about one every 7.25 years. And the average downturn, negative 40%. And so I don't think a lot of retirees look at that lump sum on the day that they retire and say, this is going to give me financial confidence throughout retirement, and then are willing to accept the possibility or the risk that over the course of retirement, they could see 3 or 4 of those downturns that are 30, 35, 40% of their money disappears without having anything to show for it, without them having spent that money.
The market has rewarded risk takers for the last, basically since 2009, Peter. You're exactly right. And investors have very short-term memories, and they need to have a retirement plan that doesn't just look at the short term, that, hedges against many of the things that can happen to you in your retirement. And the longer your life expectancy is, the more risk that you have, right? Longer things with longer durations have more risk, right? Bonds.
Yep. Well, Chris, I can't imagine that, and I don't know if you ask the question in this way, but for people who call from the program, from the podcast, who come into your office, who attend your educational courses, I can't imagine that if you were to ask the question this way, on a scale of 1 to 10, how confident do you feel about your financial freedom and stability into the future, that a lot of them are saying, oh, I'm a 12 out of 10, I'm a 14 out of 10. I imagine most of them are like, I'm a 6, I'm a 7 out of 10. What are the reasons maybe that you're hearing? And then how do you help people address that and move their confidence up a notch or two on that scale?
Sure, Peter. And having some software that can illustrate these things in real time, where we can, look at volatility in a real time environment and look what happens to your numbers. Look at it when we've got a rising inflation rate, when we've got a rising tax rates that could be out there, and then what can happen to the equity prices, if you will. So that's probably the biggest attribute that we can show people who listen to the show, our current clients, people that come into the office, is once we enter all of the data, to show them in real time, hey, if things just continue on like they are, look how good it is. Okay. But let's not base a retirement plan based on current conditions. Let's take a look at, what if some bad things happen? Okay. And then show them that and say, look, now if we did this and bad things happen, now we've got a hedge in place. And look, now you can ride the storm, if you will. Being up here on the lake, we obviously get a lot of storms up here on Lake Erie, and they can be quite violent. So I think most of our listeners understand that things whip up pretty quickly here.
Chris, would you say that your planning approach is overly optimistic or overly pessimistic? And then how does that make your clients feel at the end of that process?
Well, I think you probably go by the cliche that we plan for the worst, and anything else that happens is, makes things better. So if we've got some positions in play for the worst case scenarios and the unexpected things that can happen in today's geopolitical climate, anything can happen pretty quickly here. We've seen, not just with the pandemic, but with a lot of the hacking things that are going on. I think a lot of us are kind of worried about, how safe is our real infrastructure, here in the United States. I don't think we're worried about the Germans coming over the Maginot Line. We're more worried about a group of Russian hackers turning off the lights. And, look, we have to have some things in play. That would erode confidence significantly if we had some major, cataclysmic type event. And, if I was our enemies, that's what I would be looking at. So why not have a safe money position, to be prepared for cataclysmic events?
Well, if that would provide you with a improved sense of financial confidence in stability, freedom, and independence, a quality of life into and through retirement, knowing that you've got a plan and that within that plan, you've got strategies for some of those worst case scenarios. Pick up the phone, give Chris Mcintire a call. That is what he helps his clients to identify the risks of and then address through strategic planning, as well as maybe a little bit more routine things, maximizing your Social Security, identifying the risks that you are taking in the market, planning and strategizing to be efficient with taxes. And when you create income from those accounts, making sure that you're doing so efficiently with the right order of operations, being effective in optimizing the different accounts and assets that you have. That's all part of the planning process there at Mcintire Retirement Services to help you with your sense of financial freedom and independence. And Chris, if folks want to take you up on that offer, they simply place a call, come into the office, visit the website, McIntyreRetirementServices.com, 800-868-1194. You make it pretty easy.
Yeah, we certainly do. And Heidi will show you what you need to bring in or tell you what you need to bring in. And, we'll make a nice, efficient appointment out of it. Time is valuable for everybody. So, if we can streamline this, we certainly help people do that as well, Peter.
Well, again, just pick up the phone. That's the easiest way to get the process started. Procrastination, no one's friend. So let's be proactive here. Even though it's a holiday weekend, we want you to take your lasting financial freedom and independence seriously. So take just a few moments. Place that call now. 800-868-1194. That's 800-868-1194, 800-868-1194, 800-868-1194. Chris, we always appreciate your time being here as the guide, providing your perspective to Northwestern Ohio savers and investors. Thank you for being here, buddy.
Hey, it's my pleasure, Peter. Hope everybody has a safe weekend. Be careful out on the roads. Thank you.
Visit McIntyreRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris Mcintire. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Indexed or fixed annuities are not designed for short-term investments and may be subject to caps, restrictions, fees, and surrender charges as described in the annuity contract.